Well, thank you, Susanna. It's always a great day to be in British Columbia, and I'm thrilled to be here to speak to you today. And Susanna, I want to thank you and the Business Council of British Columbia for inviting me here. And I'm particularly looking forward to sitting down with Jacques after my remarks and discussing the issues facing the province, the challenges confronting the country, and some of the questions being put to the Bank of Canada. This is my final speech of 2022, and what a year it has been. The year-end speech often looks back to what's happened and ahead to what's next, and this one fits that mold. What's different is that nothing about our recent experience fits the mold of the last 30 years. The pandemic brought on again, off again shutdowns to the global economy, dramatic shifts in the goods and services that consumers wanted to buy, and a myriad of hurdles for producers to supply them. All of this, combined with Russia's horrific aggression in Ukraine, has brought sharply higher inflation and rapidly rising interest rates. Last week, we raised our policy interest rate by 50 basis points to 4.25%. This is our 7th consecutive increase since we began raising interest rates in March to fight inflation. Deputy Governor Sharon Kazicki explained our decision in a speech last Thursday. Today, I want to take a broader perspective. I want to reflect on what we've learned in 2022. I want to discuss what could lie ahead, and explain what we're focused on at the Bank of Canada. It's a bit early for New Year's resolutions, but I already know what ours is. Restore price stability. We are resolute in our commitment to return inflation to the 2% target. Higher interest rates are working to rebalance the economy. Domestic demand is slowing, and we expect GDP growth will be close to zero through to the middle of next year as the economy adjusts to higher interest rates. This will relieve domestic price pressures, and inflation will come down. The adjustment will not be easy, but restoring price stability is the most important thing we can do to improve the economic and financial well-being of Canadians. La Banque est déterminée à ramener l'inflation à la cible de 2%. Les taux d'intérêt plus élevés aident à ramener l'équilibre dans l'économie. La demande intérieure ralentit et la croissance économique devrait être près de zéro jusqu'au milieu de 2023, pendant que l'économie s'ajuste au taux d'intérêt plus haut. Cela va atténuer les pressions intérieures sur les prix et l'inflation va diminuer. La transition ne sera pas facile, mais il faut rétablir la stabilité des prix pour améliorer le bien-être économique et financier des Canadiens. So let me begin by looking back on the year that was. A year ago, the economy was getting closer to capacity, but we were still coping with new waves of COVID-19. Unemployment was a percentage point higher than it is now. Supply chain disruptions combined with strong global demand for goods had driven total CPI inflation up to 4.7%. But service price inflation remained relatively low, and inflation was not broad-based. At that time, we expected supply issues to gradually resolve and inflation to come down to close to our 2% target by the end of 2022. At about 7% today, inflation is a long way from what we had expected. What happened? 3 things surprised us. First, supply problems, both global and domestic, proved to be more persistent and pervasive than we had anticipated. This put upward pressure on many prices. Second, Russia invaded Ukraine, sending prices for energy and agricultural products sharply higher. And third, once we got through Omicron early in the new year, the economy fully reopened and consumers wanted to catch up quickly on what they had missed for 2 years. But businesses could not keep up with demand, and this put significant upward pressure on services prices. With the information we had a year ago, it was impossible to foresee all these developments, but it is too convenient to write off the high inflation of 2022 as just bad luck. We need to reflect on what we've learned. I see 3 lessons. First, restoring supply is harder than restoring demand. Hyper-efficient global supply chains are a marvel of system design, transportation, and logistics. And when they're working, we take them for granted. But the pandemic reminded us that a chain is only as strong as its weakest link. With the waves of the virus hitting different parts of the world at different times, supply and demand could not recover in tandem. Moreover, the large shift in demand during the pandemic towards goods and away from services put even more pressure on clogged supply chains. Businesses couldn't meet customer demand, and prices for goods rose sharply. With hindsight, the monetary and fiscal policy tools that were used to stabilize the economy worked effectively to support demand, but we underestimated supply challenges. Second, averages can obscure inflationary pressures. We need a more granular understanding of the balance between demand and supply when the forces driving demand diverge dramatically across sectors. Public health measures restricted the demand for services. At the same time, other parts of the economy were experiencing excess demand as consumers bought goods to replace the services they couldn't get. But the inflationary impact of excess demand for goods was larger than the disinflationary forces in close contact services. As a result, our inflation models that focus on the average or aggregate imbalance between demand and supply in the economy had a hard time predicting the rise in inflation. And third, supply disruptions are more inflationary when the economy is overheated. For the last 30 years, supply shocks, typically energy, have tended to have a temporary effect on inflation. A run-up in oil prices, for example, would boost inflation for a year or so, but oil prices would typically plateau or reverse, and inflation would come back down all by itself. Since it takes more than a year for the full effect of monetary policy to work through the economy, central banks have tended to look through the direct impact of supply disruptions on inflation. That means we don't respond by raising interest rates. This year, the inflation response was different. As I've already mentioned, we were faced with a series of negative supply shocks just as the economy was reopening. And the effects of these supply shocks on prices and inflation was faster and more pronounced than usual. Businesses flush with customers weren't worried about raising their prices, so they passed on higher input costs more quickly to final goods. And consumers, eager to finally be able to buy what they wanted, paid those prices. As a result, the impact on inflation of the energy and agricultural price shocks we experienced was faster, larger, and more pronounced than our models suggested. In sum, since we started inflation targeting in the early 1990s, we have not been hit by large negative supply shocks at the same time as our economy was overheating. The lesson from 2022 is that even if longer-term inflation expectations are well anchored, when the economy is in excess demand, businesses raise prices more quickly and buy more when their costs increase. All 3 lessons are linked. Sorry about that. All 3 lessons are linked, and we've taken them to heart. You don't get 8% inflation because one thing went wrong. Our experience in 2022 is that surprises can combine and interact with each other, resulting in outsized effects on inflation. And I'd be pleased to talk about these lessons and how we're taking them on board in our discussion, but I now want to look ahead to 2023. Our top priority is getting inflation all the way back to our 2% target. By raising interest rates, we're trying to dampen demand so supply can catch up. That will bring the overheated economy back into balance, and inflation will come down. Interest rate increases have begun to work, but they will take time to feed through the economy. We've increased interest rates rapidly, both because inflation rose quickly and because the economy was overheating. Once we started to see the momentum in domestic demand, we moved forcefully. Since March, we've raised our policy rate by 4 percentage points. Increasing rates rapidly to rebalance demand and supply and keeping long-run inflation expectations anchored to our target is our best chance of restoring price stability without a severe economic contraction. At last week's decision to raise the policy rate by 50 basis points, we indicated that looking ahead, we will be considering whether there is a need to increase the policy rate further. This means that decisions to raise the rate or to pause and assess the impact of past rate increases will depend on incoming data and on our judgments about the outlook for inflation. We're trying to balance the risks of over and under tightening monetary policy. If we raise rates too much, we could drive the economy into an unnecessarily painful recession and undershoot the inflation target. If we don't raise them enough, inflation will remain elevated, and households and businesses will come to expect persistently high inflation. With inflation running well above target, this is the greater risk. If high inflation sticks, much higher interest rates will be required to restore price stability, and the economy will have to slow even more to restore price stability. We are watching very closely to see how the economy is responding to higher interest rates. We're looking at an expanded range of labor market indicators to assess the balance in the job market, and the impact on workers. We're watching to see how supply chains are resolving and how businesses are passing on changes in costs to consumers. We're also keeping an eye on measures of core inflation to gauge underlying inflationary pressures. And finally, we're closely watching inflation expectations because keeping them well anchored is critical to restoring price stability. I now want to spend a few minutes looking into the future. But first, let me look back. Over the 2 decades up to 2020, a number of forces have helped keep inflation low. A stable global landscape combined with a broad consensus for free trade encouraged investment and supported productivity. Technological advancements also lifted productivity, shrank distances, and lowered costs. The entry into the global trade system of vast new labor markets in China and Eastern Europe pushed down the prices for many goods. Global supply chains grew rapidly, minimizing costs by linking the global economy through heightened specialization and trade. These supply developments all fostered a period of solid growth, low inflation, and low interest rates. But these forces are shifting. The failure to adequately share the benefits of growth have fueled populism that is causing countries to turn inward. Support for globalization is stalling or even reversing, and productivity growth is trending down. As the growth in the working-age population slows and businesses find it harder to hire workers, there could be persistent upward pressure on wages. If higher wage costs are not matched by improvements in productivity, the cost of production will increase. The pandemic and the invasion of Ukraine by Russia has also highlighted some of the vulnerabilities with interconnected trade. The pandemic made clear that relying too much on highly specialized supply chains can have downsides. And Russia's weaponization of its natural gas supply has underscored the risks of assuming that all countries share the same interests in peace and prosperity. Rising geopolitical tensions, more broadly, have underscored the fragility of some business relationships. In the future, it seems likely that supply chains will be shorter, more diversified, and more resilient. Trade will likely narrow to more trusted partners. These changes will increase resiliency, but at the cost of efficiency. And through this adjustment, production costs could increase, increasing price pressures. Over the long term, it seems likely that we won't have the same disinflationary forces that we've had for the last 30 years. These potential developments could make it harder to bring inflation back to 2% and keep it there. But how much harder is difficult to say. These are fundamental uncertainties we'll need to confront in the years ahead. But by constantly focusing on the 2% inflation target, our monetary policy framework is well designed to address uncertainty and adapt to new developments. If the inflationary forces going forward are stronger than we expect, we will start to see inflation coming in above our forecasts, and we will adjust our policy settings to achieve the 2% target. If, on the other hand, disinflationary forces return and inflation starts to come in below our forecasts, again, we'll adjust our policy tools to hit the target. Assessing the impacts of shifting forces will be difficult in the moment, but we can be confident that our framework is designed for all seasons. Let me conclude. I've spent most of my time talking about hard lessons and difficult decisions. But I want to end on a note of optimism. While global forces are shifting, the future will be a lot better than the last 3 years. Aging demographics, rising geopolitical tensions, and climate change all mean global economies could face more supply shocks than in the past. But even if volatility does not return to the pre-pandemic level, we can expect it to be much lower than we've all endured these last 3 years. I also want to stress that the future is not destiny. The future is not destiny. What we do now will influence how we are positioned when the future arrives. The more we invest in increasing supply through trade, automation, innovation, training, and immigration, the faster the Canadian economy can grow without creating inflationary pressures. Canada thrives in a world of open trade and investment flows, and its market access is among the best in the world. We need to protect this and deepen our trading relationships. Businesses need to look to the future and leverage automation to free up workers for higher value roles and provide them training to prepare them for these opportunities. Governments need to foster innovation and ensure Canada remains a country of choice for new immigrants. The Bank of Canada's job is to ensure price stability. Low, stable, and predictable inflation is fundamental to a well-functioning economy that is growing and is delivering prosperity for its citizens. People ask me, why does the Bank of Canada need to be so aggressive about raising interest rates to combat inflation? And they also ask, why do you need to get inflation all the way back to 2%? It's simple, even if it can be difficult. The longer inflation remains high and the higher it is, the harder it is for Canadians to plan their spending and saving. Inflation erodes the value of money. It distorts and confuses the information and incentives that consumers, businesses, entrepreneurs, savers, and investors rely on to make their economic decisions. It feeds frustration, social tensions, and a sense of unfairness. La Banque veut restaurer la stabilité des prix de la meilleure façon possible pour les travailleurs et les entreprises d'ici. On sait qu'il est difficile de s'ajuster, mais ça en vaut la peine. Notre politique monétaire donne des résultats. Et quand le pays sera adapté, l'économie pourra progresser sainement et l'inflation sera basse. Voilà ce que l'avenir nous réserve si nous persévérons. We want to restore price stability in the best way possible for Canadian workers and businesses. We know the adjustment is difficult, but it will be worth it. Our monetary policy is working, and once we get through this adjustment, our economy can grow healthily with low inflation. That's what lies ahead if we follow through. Our resolution is simple, and our resolve is absolute. We will restore price stability for all Canadians. Thank you very much. You want me in the front?
Actually, this one.
This one's for me? Okay, I got 2 glasses of water. I'm fully loaded. Oh, that's comfortable.
Well, thank you very much, Governor, for those remarks. We're going to continue the conversation on some of the topics that you've brought forward here over lunch, and then I'll select a few questions from the audience with an eye to the principle I always use in these things, that is to not let the perfect be the enemy of the adequate in selecting questions. So that's the approach we'll use. You know, you touched on some of the forces globally in the 3 to 4 decades up till 2020 that created a powerful tailwind for low inflation. The ongoing globalization, the entry of China in a very major way into the global production system, especially for manufactured goods, the demographic dividend associated with the rise of the baby boom generation that augmented the size of the workforce, rising female labor force participation, which was a very powerful factor in countries like Canada. As I know you've read the book by Charles Goodhart and Manoj Pradhan, 2 UK economists, called The Great Demographic Reversal. They argue that these tailwinds are now shifting into headwinds from the perspective of inflation. It's going to be a lot harder to achieve the low stable inflation that we enjoyed for three decades plus. And the implication of that is that people should be planning for, in a sense, a higher equilibrium inflation rate going forward, even though you've recommitted the bank to the 2% target. Could you just explore a little bit further some of the forces that these authors have identified and how they're going to factor in to the challenges that not only the Bank of Canada but other central banks face in trying to get inflation back down to the current targets?
Jock, as you've highlighted, there have been a number of disinflationary forces that have allowed for solid growth with really quite low interest rates for really most of the last 30 years. And I talked about some of them, just to focus for a minute on supply chains. I think earlier in this crisis, when we thought the supply chain disruptions wouldn't last as long, we thought supply chains might go back more to normal. But as these supply chain disruptions have been, they've lasted a lot longer than we thought, and they've been much more pervasive, I think increasingly supply chains are not going to be going back to pre-pandemic normal. Talking to businesses, certainly what we're hearing is that supply chains are becoming shorter, more regional. Businesses are shifting from just in time to just in case. They're holding more inventories. That's probably needed in a world that's got more supply shocks, but it does mean that there's going to be more cost, and through that transition, that will put some upward pressure on inflation. On demographics, look, there's no question the baby boom generation is rapidly moving into retirement. Labor force growth is shrinking. We are very lucky in this. We are very fortunate in this country that we have relatively high rates of immigration. BC, in particular, has even higher than the national average. That's actually really boosting our potential going forward, but it's not going to be enough to offset the declining labor force growth. And so it is going to be harder for businesses to hire all the workers they want. And then a third one I'd highlight is climate change. And in BC in the last couple of years, you've really lived that with heat waves, floods, forest fires. And what we're seeing is that not only is this affecting people's lives and livelihoods, it can knock out key bits of infrastructure that have broader, and we see that here in BC, knock out key roads, key bridges, which can have larger effects on the economy. So, on the other hand, look, technology is still advancing. Companies are adapting. If it's harder to get workers, they're probably going to invest more in automation, new technologies. There will be some adaptation, and there are some factors on the other side. But while I wouldn't go quite as far as their book, Yes, I do think the disinflationary force, we're not going to have the same disinflationary forces going forward as we've had in the past 25 years or so. But Jacques, I'd highlight two things. First of all, I'm not hearing from Canadians that they're okay with high inflation. What I'm hearing from Canadians is that this is painful, and they expect and they want inflation to come back down. And the other thing I'd highlight is that our framework is well adapted to dealing with these uncertainties. It's really a matter of degree. And it's hard to judge right now how much more difficult it will be. But these are relatively slow-moving forces. They're not like the pandemic that hits the whole world at once. And particularly for these slower-moving forces, I do believe that our inflation targeting framework is well adapted to deal with these kinds of uncertainties. As I mentioned, if there proves to be more inflationary forces than we built into our forecast, well, we'll start to see inflation's coming in a bit above our forecast, and then we'll know, we've got some more work to do to get inflation back to target. I don't think it means that we don't want to get inflation back to target. I think Canadians want low, stable inflation. It's served us well for the last 30 years, and it's really foundational to a well-functioning economy.
Thanks for that. Economists often talk about an economy's potential growth rate over the medium and longer term. And we haven't heard too much about that lately because we're in the middle of this rather unusual kind of business cycle. But I think you know well that potential growth is quite critical to future prosperity, but also to the decision-making of the central bank. So could you just unpack for us a little bit what is potential economic growth and how that is factored into decision-making that a central bank undertakes?
Well, potential output, unfortunately, is not something we can observe directly. It's the amount of goods and services the economy can produce without generating inflation. So it's like the sustainable non-inflationary rate that the economy can grow. And there are really two key building blocks to potential output. First is how many workers you've got in your economy, size of your labor force. And the second is what is the output per worker, or what we call productivity. And potential output has been very difficult to measure through the pandemic. Productivity in particular has been very difficult to measure. It's been very distorted as you've seen big shifts between sectors. But I think it is fair to say that, and look, you all run businesses, I don't need to tell you, productivity has been lower during the pandemic for a whole range of reasons. You've had to implement various protocols to make sure your customers and your employees stay healthy, more cleaning, etc. And you've all been coping with disruptions in your supply chain, which has made it much more difficult to plan and optimize your production. As those things go back to normal, we should see some improvement in productivity. And the other thing we're hearing from businesses is it's very hard to find all the workers you want, so you're investing more in training workers, you're investing more in new technologies so that workers have better tools so they can produce more output per worker. So we do expect productivity to rebound. And coming back to the other building block of potential output, that is labor force growth. And I already talked about with the aging of the baby boomers, as they move into retirement, labor force growth is declining. Fortunately, we do have very high rates of immigration in this country, and that will increase our potential output growth going forward. So just to give you some numbers, Jacques, productivity growth has actually been, it has been quite disappointing through the pandemics, actually. In 2022, we think labor productivity growth is actually slightly negative. Going forward, we think it's going to be positive, about 0.75%. But the bulk of growth is going to come from labor force growth. That's probably 1.25%, 1.5%. So our potential growth going forward, we think, is about 2%. So that's the sort of growth rate the economy can sustain without generating inflation. Keep in mind, though, right now, we are operating in excess demand. That means the current output of the economy is above potential output. Economy's operating up here, potential output's down here. Economy's slowing, so these things are getting closer. But as long as actual output is above potential, that's generating inflation. And that's why we have to slow the economy and bring these two into better balance. And the last number I'll give you, just to show you how important the growth of the labor force is the U.S. economy. We like to compare ourselves to the U.S. If you look at the U.S. economy, we actually think its potential growth is a little bit less than Canada's, about 1.7. Productivity growth in the U.S. we think is faster than in Canada. I'm hoping the business audience here has, the ambition to match the U.S., but historically we've had trouble doing that. But where we have a big advantage is on labor force growth. We have much higher rates of immigration in Canada than the U.S., so our labor force growth is going to be certainly well over 1%. Theirs is only about 0.3, 0.4.
Interesting. Obviously, investment, capital formation is one of the critical ingredients in determining potential economic growth. And it's a topic we've been exploring in a number of different ways at the Business Council over the past couple of years. My colleague, David Williams, has done some blogs and papers that probably have dug deeper into this in the BC context than anything that's been published before. And the picture that emerges from that is, kind of broadly similar to what we see at the national level, which is that capital formation has been weak, structurally weak for a long time. In Canada, the latest numbers I looked at, business investment in machinery, equipment, plant, digital process technologies, and intellectual property products in the Canadian business sector is running at maybe 60% of the U.S. level on a per employee basis, which is concerning from the perspective of where are we going to get the productivity growth going forward. What is the kind of bank's perspective on the investment performance and trends in Canada, and how those match up with where we want to go as a country? Because it is something that's quite striking, at least to us, that there seems to be a growing gap, frankly, between Canada and the United States in the pace and composition of capital formation. By capital, I mean things that actually make us more productive over time. So any further insights you can kind of share with us on that big and I think quite important topic would be appreciated.
Well, I'd largely agree with your summary, Jacques. When you look at the Canadian economy, we've grown more by labor force growth. And there's nothing wrong with that. And what is that? Again, we compare ourselves to the United States. We've done a better job we have a more inclusive labor force, particularly our participation of women in the labor force is quite a bit higher than the U.S. That's certainly been a source of growth. I've already mentioned we have higher rates of immigration, and we do a pretty good job of integrating immigrants reasonably quickly into the labor force. Where we haven't done as well is in productivity. And as you mentioned, that is very directly linked to investment. The more businesses invest in new technologies, new tools, the more productive our workers. Going forward, as I mentioned, immigration is going to dampen the effect of the aging labor force, but the reality is labor force growth, even with immigration, is going to be going down. It's going to be harder for businesses to hire the workers they want to meet the demands of their customers. That is going to put more of a premium on investment. Because if you can't hire more workers, if you want to increase your output, you got to increase the output per worker. So that's, and you're already seeing this. Businesses, they can't always hire all the fully trained workers that they want, so they're hiring workers and they're investing in training. I think and I hope that we see more of that. The other thing we're hearing from businesses is businesses are hitting up against capacity constraints. They can't meet all the demand of their customers. They're leaving money on the table. And so they are increasingly, their investment intentions are strong. As the economy slows, you can certainly see that there's some backing off on those. But I think it will be important for businesses to try to look through that and look for opportunities to use new technologies, use automation, to allow workers that are going to be in shorter supply to focus more on higher value functions. So, we've built as I mentioned earlier, we've built some recovery in productivity growth into our projection. I would love to be surprised on the upside. I'd love to see that to be even stronger than it is. But given our record that our productivity growth has tended to be below the United States, we haven't built too much optimism into our forecast.
I'm now going to turn to some questions from the audience that I think would be useful to throw on the table here. One is the impact of interest rate increases on inflation. Many people probably are under the mistaken view the impact is immediate, but we know through economic history and research that there are long and somewhat hard to predict lags between the decision to move interest rates higher and then the ultimate effect that has on economy-wide spending. So what is the perspective of the bank on the appropriate time frame for thinking about the impact of interest rate changes on aggregate demand in the Canadian economy?
Well, the short version is higher interest rates, they affect spending first, and then eventually that starts to affect inflation. So how does that whole process play out? Well, the effects of inflation the full effects of inflation take 18 months to 2 years. And so if you look at our forecast for inflation, we have inflation coming back to the 2% target by the end of 2024. So that is some ways off. It is going to take some time. We are, though, already very much seeing the effects of higher interest rates in the economy. You can see those very clearly in the housing sector. Activity in housing has slowed very sharply. You're starting to see housing prices that went up a great deal through the pandemic come back down. Overall, in Canada, they're down about 10%. You can also see the effects of higher interest rates on other more interest-sensitive parts of the economy. So consumption, particularly of goods. You can see that is starting to weaken. And, looking at the BC data, I think that, that's what you see in Canada. That's also what we see in BC. So, look, we've raised rates unusually rapidly. We know that we're starting to see the effects, but we know those interest rate increases, we have not seen the full effect yet. More of that is coming through as we go forward. And so where we're sitting right now, we've raised rates a lot. We're considering whether we need to raise them further or perhaps pause and let the increased interest rates that we've done pass through. And those judgments are going to depend very much on incoming data and, importantly, our outlook for inflation.
One of the things that obviously the bank has to pay attention to is especially in a rising interest rate environment, is the levels of debt that have built up in the economy in aggregate and across different segments of the economy over time. And again, my colleague David Williams, who used to work at the Bank of Canada, has done some work on what's happened to Canada in terms of the buildup of economy-wide debt. This is household debt, public sector debt, and non-financial corporate debt combined. Canada's in the top 4 or 5 countries in the world in having the highest levels of economy-wide indebtedness, up with some of the Scandinavian nations. Household debt in particular is extremely high in Canada by OECD standards. And unlike our friends in the United States, we don't have 30-year mortgages. So our households that have mortgages are much more exposed to rising rates here than their counterparts in the U.S. What does the analytical work and modeling of the bank tell us about the sort of potential vulnerability of the Canadian economy because of the very high levels of debt that have been built up? That's something I know that you're paying close attention to.
Yes. So on the debt levels, it's really household debt in Canada that is particularly elevated. And we have been highlighting this as a vulnerability for some time. For monetary policy, really, the implication is if households are more indebted, monetary policy may have more traction. It may work faster and more strongly than it has historically. So that is certainly something we are watching closely. On the other hand, households through the pandemic built up what economists call excess savings. We couldn't buy many of the close contact services we wanted. We couldn't go on a vacation. We couldn't go to a restaurant. So some of the money that we would have spent on those things is accumulated in our bank accounts. So you are seeing, on the one hand, higher interest rates with higher indebtedness could have a more rapid effect. On the other hand, Canadians may have a little more liquidity. So we'll have to watch. We'll have to watch those things. Look, there's no question that if you bought a house near the peak, you took a variable rate mortgage with a high loan-to-income ratio, you're really feeling the squeeze of higher interest rates. That is certainly something that we're well aware of and we're watching closely. For many Canadians, on the other hand, if they have a mortgage and they bought their house some time ago, they saw big appreciation in the value of their home through the pandemic. Yes, their mortgage will reset. Most people have 5-year fixed mortgages. At some point, those will reset. They'll probably reset at a higher rate. But by and large, those Canadians should be able to manage that. Look, the housing market was unsustainably hot for the last couple of years. Part of getting the economy into better balance is getting a housing market that is in better balance. BC, housing is a big deal. It's a big part of your real estate's a big part of your economy. When you look at the BC economy, it looks pretty similar to the rest of the country. You had a very rapid recovery. Unemployment in BC is actually a bit lower than the national average. Inflation's a bit higher. Your housing market is certainly weakened markedly. Housing prices are starting to come down. That's part of the adjustment of getting the economy into better balance. We certainly don't want to see it get carried away, but we do have an overheated economy, and we're not going to get inflation down if we don't get it into better balance.
One of the things we notice is, sort of structural change in the economy is making it increasingly challenging, I think, to analyze what's really going on. So we've got the sort of digital revolution that is having an enormous impact on the way households behave, the way businesses invest and do business. We've got an economy where intangible capital is playing a much bigger role relative to tangible capital in shaping, for example, market caps of companies. And intangible capital seems to be sort of inherently harder to get your hands around analytically. Services are growing, continue to sort of grow faster than goods production in most advanced capitalist economies. All of these forces, I think, probably present some challenges for the analytical work that policy institutions need to do to understand what's going on. How is the bank kind of responding to the sort of digital era, to the rising importance of intangible capital, and to the growing kind of complexity of economic activity in modern industrial economies to support the decision-making that you and your colleagues on the Governing Council are charged with undertaking?
Look, Jock, you're right. As the economy, this has been a long process. The economy, moves away from manufacturing and other types of goods production, natural resources, and the service sector becomes a much bigger part of the economy. Services are inherently harder to measure than goods. Digital is a new dimension of that, and also having increasingly many services provided by companies that don't even reside in Canada. All that makes the measurement of the economy more difficult. We do have a first-rate statistical agency in this Canada, Statistics Canada. They are working, they can't actually deal with this by themselves. They need to work with their counterparts in other countries because, our imports are in other countries' exports. And if you want to measure the digital economy better, the major statistical agencies need to work together. So they are working on that. It is going to take some time. And we're certainly working, we do consult with them and give them good advice on what we see as the priorities. How we're adapting, I would say for us, so, on the other side of it is there are now all sorts of new types of data. There are new, we have access to new, very large data sets. TransUnion data set, for example, gives you, detailed information on people's actual spending, credit, mortgage behavior. So we can look more under the hood and see how, for example, higher interest rates are affecting Canadians in different situations with this much more granular data. Through the pandemic, we've also, obviously the pandemic, a completely unprecedented situation, so we started looking at other types of data, mobility data, restaurant bookings. These give you sort of real-time proxies for what people are doing. And the other thing I'll mention, Jacques, is, and you would know about this as a former Bank of Canada board member, we have our Business Outlook survey, which is a quarterly survey. We survey about 100 companies a quarter across Canada, and these are in-person interviews, and probably some of the companies here have participated. Thank you. It's very valuable for us. But we've recently started supplementing that with something we call our Business Leader Pulse Survey. So this is an online survey. We can do it, because it's online, we can do it more frequently. We actually are getting, you have a lot more participants. It's particularly helpful at getting more to small and medium-sized businesses. And we can put very topical questions into these surveys and get very good real-time feedback. So there are opportunities to supplement the official statistics more and more with new types of data.
Continuing on the theme of sort of technology, a year ago, the estimated value of cryptocurrencies and other sort of crypto assets globally, and I apologize for introducing a topic that may be painful for some of the people in the room if they invested at the wrong time, but over $3 trillion US. Today it's $750 billion and change. We've seen an extraordinary deflation of the crypto bubble. But back in that era where crypto assets were soaring, there was a fair amount of interest in what were central banks going to do in response to this, with some discussion of the potential creation of central bank digital currencies. And I just came back from the US. That still seems to be a bit of a conversation piece in Washington. So although the crypto markets have adjusted rather savagely, one would assume that these technologies are going to stick with us. So what is the Central Bank of Canada thinking about in the context of a potential central bank digital currency for our country?
So whether or not Canada has a central bank digital currency is ultimately the decision of the government, of Parliament. But we certainly want to make sure we're ready. So, come back to cryptocurrencies. First of all, they're a bit misnamed. Cryptocurrencies are not currencies in any conventional sense of the meaning of the word currency. You cannot, or at least not very easily, use a cryptocurrency to buy your groceries or fill your gas tank. One of the most important features of a currency is that it keeps its value. Well, cryptocurrencies, as we've all savagely witnessed, to use your word, their value is incredibly volatile. They are not very good stores of value. Most of the activity in crypto is largely speculative investment, and we've obviously seen a very rapid adjustment. The one thing I think that is somewhat fortunate is that the crypto world has not become very connected to the sort of mainstream financial world. So we have not seen big spillovers into broader financial markets. It's been fairly, very painful in crypto, but hasn't spilled over too much. But coming back to the Bank of Canada, so what would be some of the conditions under which you'd want to have a central bank digital currency? Well, one would be is if you really started to see rapidly declining demand for our physical banknotes. If everybody just wants to work in a digital money, at some point, if the demand for Canadian banknotes collapses, we could lose control of our own monetary sovereignty if they start to use other digital currencies. So that would be an important reason why you'd want to introduce a digital currency. I mean, we are seeing, so just to be clear, demand for banknotes actually continues to rise. It's not rising as quickly as nominal GDP, but it is continuing to rise. It's certainly not collapsing. The other reason, if there was, if a private sector stable coin were to catch on, particularly if it wasn't denominated in Canadian dollars, it was denominated Imagine, Facebook had Diem. It's pretty much a dead project. But, if something like that had caught on, here's a currency that's not in Canadian dollars. Again, we could lose control of our monetary sovereignty. So we certainly want to make sure that we're ready. The other, those conditions are more sort of, you introduce a central bank digital currency more to play defense. I think over time, it is conceivable that in a more digital economy, it might make sense to give Canadians the ability to hold central bank money in digital format. So we're making sure we're getting ready. We did a lot of research into what a central bank digital currency would mean, how to design one, and we're now moving more from the sort of the R part of R&D to the D part, and moving into developments. And there you've really got to think about both the technology and the policy implications together. And the other part that you're going to see in 2023, we are going to be consulting with Canadians in terms of, we're going to be talking to Canadians. One of the important objectives we put out for ourselves at the Bank of Canada is to be better listeners. And so we want to know, what are Canadians' interests in a digital currency? What are their expectations? What sort of elements would be important to them? So we will be consulting in 2023 with Canadians on that.
Well, thanks very much. On that note, we're going to have to wrap up here, and I'll turn it over to somebody else from the organization to officially thank you. Thank you.
Thank you, Jock.